Everybody, this is Rob Kientz with the Freedom Report, and today we're going to go over the weekly market report. We're going to go over economic data, some comments from Powell speaking to Congress right now as we speak, and comments about inflation and interest rates, which would be very important. We'll go over gold and silver like we normally do. We're going to look at credit card usage, which is spiking again, as people don't have enough money to basically make ends meet. And then I'm going to have some commentary at the end that I want you guys to stay for, because I'm going to talk about the industry in general and some things that you guys need to look out for, particularly during the summer months. The summer months tend to be a little bit slow news-wise and from a precious metals perspective, particularly. And there's some warnings that I want to give you of things to look out for and be careful of in the summer months, the type of stuff that you're going to see. So stay tuned for that commentary at the end. But to get started, like we always do, we're going to look at the economic calendar. As I look at it, the main thing was unemployment rate last week, spiked up to 4.1%. That's the highest it's been in quite a while. And if we look at something called the misery index, which is unemployment plus inflation, we're going to see that that is starting to tick up. When people don't have jobs and prices are rising, that makes it very hard for people to afford even the most common things. We'll look at that here in a moment. But just know that the unemployment rate is rising. Inflation hasn't come down. This is why the Fed is not cutting rates. So moving on to the comments from Powell, they say that they've made progress on both unemployment and inflation. And by unemployment, he means that they stopped the runaway labor market. It was at one point in time in which particularly white-collar jobs requiring college degrees, there were not enough applicants to fill positions. That's kind of come down a little bit. And I think the Fed sees that as a positive. They saw that the employment market was too hot. That signified to them that things were too good and was likely to lead to rising inflation as consumers spend more because they have more income. I think that was because it only looked at the participating workers. It didn't look at the unemployed and the disaffected, which is more reflective in the labor force participation rate. So labor force participation rate has not improved in over 15 years. And so even though a segment of the economy was doing well, overall, I don't see that as a great reason to view the economy as strengthening, because overall there are less people employed, and the people that are getting jobs are either working for the government, so it's increasing debt, which is going to be a cost that we all had to pay down the line. It's not a solution. Or they were working private jobs, but they were part-time. So the unemployment situation's not gotten better. I think the Fed is cherry-picking their data and gaslighting the American public, much like the financial media does. And I think they're covering up the fact the economy is much worse than it is. If you look at inflation, it's risen a little bit, although it hasn't gone into a big cycle of getting near double digits like it did a year and a half or so ago. So overall, though inflation hasn't moderated, the situation with unemployment inflation is such that the Fed is doing nothing right now. They're staying in the middle. The testimony from Powell and from the other Fed governors has basically been they thinking about cutting once this year, or last year they were talking about 3 times. They've already backed up into saying maybe once. Everybody wants them to do it twice and want them to do it once in September and once at the end of the year. The Fed has not committed to that. So the main point I want to make here about the Fed is that I said that this would be a turbulent year, and I said the Fed would be between a rock and a hard place. Well, we've had turbulence in the markets, as evidenced by the gold price, as evidenced by consumer spending, and we've had issues with the Fed not being able to cut rates. And that's exactly what I said would happen. If they cut once this year, I won't be surprised if they do, because I think they'll do it for the presidential election, probably do it in September, October, to try to keep things calm leading up to it, economically speaking. I do think that there is a chance they could do a second one this year, but I don't think that they will. If they did, there'd probably be 2 quarter-point cuts. I don't think they'll go beyond that and try to bring the overall overnight fund rate below 5%, because I don't think they can, because I think they're seeing recessionary forces. They're just not telling you that. They're not trying to panic the public. I think they know what's going on, but they're cherry-picking the way that they present the data while hedging the earlier comments that they thought the economy would do really well and they would cut 3 times. Obviously, that is not going to happen at this point. Again, what I said last year, this time last year, I was basically saying that would be the case. Looking at the rest of the economic data, unemployment came in fairly weak comparative to what people expected. There were a lot of downside revisions to previous months, which basically means when you see that number printed every month, you have to take it with a grain of salt, because it's never correct, and they almost always downward revise it. That's been the trend the last 10 years. And so they not only was this month's unemployment not good, but the trend was down. The revisions were stronger than anticipated for previous months. That's why the U3 unemployment rate went to 4.1%. Of course, we're still at 37% unemployment rate on the labor force participation, which means 30% of people who are able to work are not working, and that's the real number. Overall, hourly wages did rise by 0.3%. That's substantially less than the CPI, so it's not going to catch consumers who have jobs up with inflation. So likely they're going to want to save more and prepare for prices getting more expensive in the future relative to the raise and the value of their earnings. A good way to do that is, of course, getting to gold and silver. It tends to capture inflation and evens out those losses that you have, or at least what you can by what you can afford, to purchase. Overall, not a whole lot of other economic data. Consumer credit did spike. It's 11.4 billion this month. That's not the 30-some billion we saw last year, but 11.4 billion is a lot, and it means consumers are putting on credit card again, because wages aren't keeping up with inflation. They're not getting the high quality full-time jobs or more part-time jobs. Overall, less amount of people working than before, while inflation is being stubborn and not going down. That is the misery index, which we'll get to here real quick. Let's put that on screen, the misery index. So the misery index, like I said, is a measure of there we go, is a measure of the consumer price index plus unemployment rate, which makes sense. You're living in misery if you're not employed and prices are rising, and you're whittling down your savings or borrowing money on credit cards, which is what we're seeing. Of course, I don't believe either one of these numbers. I think unemployment's much higher. I think it's 37% when you look at labor force and participation rate. And I think when you look at the CPI, I think it's balderdash. I think we're sitting at 15% inflation. So I would put it at like 42 to 44%. But that's not the way they measure it. But one thing I wanted to point out, though, is we have a nice spike here. In 2020, it went up because of pandemic. There were a lot of shutdowns, a lot of job loss, and prices did spike, especially when we tried to restart the economy. And that's why you got that spike. But look at the line. We're at levels not seen since about 2014, 2015, which was the come down from the collapse in 2008. If you look at the collapse in 2008, the misery index increased. More unemployment, higher costs in the economy. Then it took a few years to come down. But now it's back to where it was sort of at the end of the last crisis. In other words, we're going into an upward cycle in terms of unemployment and consumer prices, inflation. And that's going to lead to more misery. And that upward cycle is going to go quite high, I believe. And we're in the beginning of that moving up. Again, another indicator of the lack of quality of life of people, the issues with it's a recession indicator, essentially. We're in recession. We've got stagflation right now. We don't have good job creation. Prices are marching up. People can't make ends meet. They're on credit cards. And that's why that misery index is starting to increase. And we're at the beginning of a base of what's going to be a large increase over time as we head into the next recession. Looking at the financial data on CNBC, the stock markets are basically about even today. S&P is up 12 points. The Dow Jones is down 31. NASDAQ is up 48, Russell's down 8. Nothing hovering near 1% or more, so nothing to speak about on the markets. But overall, the U.S. stock market's hovering near all-time highs, not sitting at all-time highs, but hovering near. And that'll be the last one to go, the last thing to come down as we head into the recession. I've talked about why that's the case. Moving over to cryptos, we have had a fall in the Bitcoin price. Right now, as I speak, it's trading at 57,648. Up $1,200 on the day. This is about 11:15 p.m. Central Time that I'm recording this. It'll change by the time you see it. But as of now, it came down, though. It was at 70 at its high, came down to about 61, 62, hovered at 60, 61. It's now fallen below 60. There's a little bit of weakness in the crypto complex. If you look at Bitcoin Cash, it's at 333.96, up about a 0.57. Ethereum Classic is 20.8, up 51 cents. Litecoin is at 65.9, up 96 cents. Terra, unchanged, sitting at 0. XRP is down to 43 cents. Last week it was 48. So overall, the crypto complex has had weakness. People aren't putting as much money into it. The ETF funding has not led to that being consistently higher. So you still see that cycle, much like you see in finance in general, and much like you see in gold and silver, you're seeing in the crypto complex as well. And those cycles tend to be pronounced because it's highly speculative, less about the currency, more about speculation. And I think with additional ETF funds, we're seeing that. So I expect to see overall the crypto complex come under pressure until we see the next big bout of news, in which people may look at it as a safe haven, or look at it and say, well, other people are going to see it as a safe haven. I want to capture the upside on that. So they'll get back into it. But I think it's possible Bitcoin could fade this summer, much like gold, silver will probably do. Overall bond rates are down just a bit from last week, although we're still in yield curve inversion between the 2 and the 10. And that's the only thing to report there. Summer is generally a little bit slow in terms of financial markets. I'll get into that at the end. I'm going to do the gold report and gold and silver real quick. We're going to do a quickie because not a ton of movement, just a couple of things to talk about. I'm going to talk about the commitment of traders, and then I'm going to talk to you about what you should look out for in the gold and silver market in the summer. And this applies to any market, but specifically gold and silver. You guys are going to want to stay there for that because I'm going to reveal some hard truths that, you know, may surprise people. In any case, let's get back to the share and let's talk about the gold and silver markets. We're going to go to the CME Group's website, as we always do. And we're going to talk about where gold is. This is a gold chart. The one thing I want you to pay attention to on gold is the EFPs are at 10,745, as you can see here on the top line. Let's see if I can make that. Yeah, one spot bigger. On this top line here is the latest data for today as of about 9:10. Well, basically, it's yesterday's data. And the exchange for physical, it's where you take a contract in the US and you go over to London, you're hunting for physical. It's 10,745 across 2 contracts. You have 5890 EFPs here on the August contract, which is a pretty sizable. It's the dominant one right now with 327,000 total contracts open interest as of close yesterday. But you also have December, which is going to be the annual largest month as we get to the end of the year, as it always is in gold and silver. And you had 4,855 contracts of December going over to London saying, can we get better prices or can we get the physical? That's a sign that people are really heading for the physical as the economy starts to show more signs of heading toward that collapse and heading toward that recession we all expect. Overall, very healthy volume on gold. 510,000 contracts traded yesterday, or open interest, I'm sorry. As of yesterday, it's elevated, as you can see it on the chart, 510.67. It's 507 earlier on the 5th of July and the 8th of July, 510. Right now, we're sitting at, what was the number? 510, yeah. So overall, pretty high numbers in terms of interest. So there is a lot of trading for the summer months on the derivative markets. It's increased just a little bit. Volume is strong. Block trades, when people agree ahead of time to a trade and they put it on the market, is up. The trade at settlement order type that specifies the day settlement price is the order price. So what the trade at settlement does is it takes a set price, and you're not going into the market affecting the price up or down when you make this trade. You're saying, we'll use the last settled price as our price. Let's agree to it, make the trade, and then put it on the market. What that does is have the effect of more price stability in negotiating those contracts. Why is that important? Well, it's an indication that people are looking at the extreme volatility in the gold and silver markets and the price movements, and they don't necessarily want to put a trade in and get the wrong price. They're really trying to limit their exposure to price differentials there. But they're also saying, if we put in 16,418 contracts all at once, we may affect the price as well, and that may move the price and take us away from our target. And then there may not be the liquidity at the price, at the settlement price that they had previously. So they're going to use that previous settlement price. They're going to agree to it, put it on the market. And it's a safer way to trade at an established known settlement price. You could think of that as like a fix or a temporary price that they can use to trade to, versus going to the market and just dealing with the volatility or creating additional volatility with those orders. These things like the EFP, the block trade, and the TAS are things that have been amped up along with the Clearport. The Clearport is private negotiated trades, which may be reported through Clearport, clearing service for over-the-counter markets, or directly into CME. So this is more like an over-the-counter trade where people agree to the price, like on London, and then bring it to the market versus using the market prices. So what you're seeing is a lot of people go in here and say, we're using these other mechanisms to lock in contracts at the prices we want versus putting it onto the market. And that's because there's such increased volatility on the market that people are trying to avoid that. That's a sign of volatility in the markets. It's also a sign that there may not be quite as much metal liquid as we think. And people are doing these more private transactions to kind of handle that versus going to the open market. If you identify someone that has metal and metal delivery is a part of it, you're going to want to settle outside versus maybe going to the market and trying to force one of these shorts to cough it up. Of course, there weren't a whole lot of deliveries, only 463. So a lot of this wasn't for delivery, but as people are searching for that gold or they're searching for specific price points, they're going to use these sort of off-market mechanisms. And that's a sign that the market doesn't trust the volatility in the price. There's pricing risk there. Settlements, the only reason I show this is to show this or spot price is determined. It's not determined. It's your local dealer. Has nothing to do with physical trade. 99.9999999999999999997,009% of the time. But what you get is this tells you where the prices are. So yesterday it was down about 34 cents. That's Monday's data. On Friday, you're up about 28. It just shows you the way the market trades, and it all has to do with what? It has to do with the paper trading, you know, these 510,000 open contracts on these various months. That's what determines the price. That's why I show it. On to silver, looking at volume and open interest. Silver popped up a bit at the beginning of the month. That's typical when you see some deliveries. Typical at the beginning of the month that people will roll their contracts or make their decisions on where they're going on these futures contracts. So to see a little bit of spike in open interest at the beginning of a month in silver or gold is not abnormal, although you saw it spike for a day and came back down. Spiked after the holiday and came back down. It's just delayed holiday trades. There's nothing there. But what we're looking at is about 162,000 contracts at close as of yesterday. EFPs were elevated for silver. This is pretty high. Remember, these are 5,000 ounce silver contracts as opposed to 100 ounces in the gold. And you had 825 of those. So add those numbers up. 825 times 5,000. That's how many ounces physical exposure were sought, and you couldn't get them in the COMEX, or they didn't feel like they could give them a COMEX, so they took COMEX contract and forwarded it over to London. You've also got a little bit of block trading in here, a lot of trade after settlement, a little bit of clear port. So again, those private transactions negotiated out of sight of the normal liquidity of the market to try to either lock in price or to avoid that price exchange risk. Well, why is that the case? Because there's a lot of big trades going on in the market overall in gold and silver. It's become, even during the summer, a little bit more frothy than usual. And that's because there's so much interest in gold and silver because of all the risk in the world. And so we're starting to see those other trade types get more use. They've always been there, but they're getting more use. And that's a sign of a little bit of uncertainty in the market and people trying to really pinpoint and reduce market risk because of those prices. All right, settlement data for silver down 77 cents yesterday, as you can see in this change column here. As you look at Friday, up 84 cents. Again, sideways trading market. Going over to commitment of traders, this is silver through July 2nd. Remember, it's in arrears. It's old. It's a week to 10 days old, according to the CFTC puts it out. But this is off their website, the latest one sitting right there, as you can see on the address bar for the browser. And we look at this to see who's doing what. Now, I almost always ignore producer merchants unless I see something weird. They're typically more short than long because you have more of the miners in there trying to protect their price risk, because the miners make such a low profit on all of this stuff that they have to guard against price movements. And because they're producing it, they're protecting against downside risk. So if the price moves down, they got to have a way to make money when the price moves down. So they take a short. It seems counterintuitive. Why wouldn't they take a long? Because they want higher prices. Well, they're not actually trying to move the price. They don't have enough volume to do that. What they're trying to do is say, if the price comes down the next 3 months, I want a short contract to profit off of that to offset the go-to market price when I take my physical, which is lower. And they're so price sensitive. A lot of these mines will shut down when the prices go below certain thresholds and they can't get enough money to fund their mining. So there's always going to be a concentrated short there, and that makes sense. So what I really pay attention to, these other 3 categories: swap dealers, managed money, and other reportables. These guys right here. The swap dealers are the big banks, so the big speculative. They're the ones that almost always have the big short. You can see in the short column, and you can tell down here that those guys are 53% short of the silver market, 8 entities. It's concentrated silver shorting, and almost all of it's through the swap dealers. We know that from the Office of the Comptroller of the Currency report, which I'll show you at least a few times a year, which basically names the big banks doing that. It's there in black and white on a government report. Then you have the managed money, which are financial houses, and then other reportables are like family offices, wealthy individuals, things like that. So that's kind of the breakdown of everybody other than miners and the guys using it, like Apple and stuff, using the product. Those are in this category over here. But the interesting thing is always swap dealers. They took about an even number. They dropped about an even number of long and shorts. Overall, the interest dropped 11,746 on the market. Again, it's summertime. Every week, there's overall less exposure because the market moves less. The news tends to be a little slower. There tends to be a fade in the price. And so there is less interest on the market. This is just in the data. When I go to Twitter and I talk about that, people get mad, but that's just the way it works. Seasonality matters in gold and silver market, and the summer tends to be a little bit weaker, and you get a price fade and less amount of trading as well. That's just normal. But overall, the swap dealers didn't do much. They dropped about an equal number of longs and shorts. They're still almost historically short. Not quite historically, but this is a big short position for them. A few months ago, it was dead even. Sometimes there's a difference of 10 or 15,000 contracts. They're 2 point something to 1, almost 2 1/3 to 1. Short to long. They're holding a very heavy short over the market over summer. This keeps the prices from rising. Why are they doing that? Well, one, because they know the seasonality of the trade, so they're going to take more shorts to profit from it. But also by putting in the shorts, it affects short pressure, which helps them meet their price target, not only in the futures market, but also in the options market. And they make money both ways. The managed money financial houses are net long, as they typically are, and so are the other reportables, because they're taking a longer term position and they see the economy and they're like, we're going long silver. Smart thing to do. In the meantime, they're going to lose money because the banks are trading against them on a daily basis and they're going to take their money. Because for all intents and purposes, when you control 53% of the shorts, 8 entities, you're going to make money by moving that market. You literally, 8 entities conclude to move that market very easily. Same thing in gold, 57.1% of short trades are in 8 traders. Same report, here's gold, same date, through July 2nd. Gold had a lot more shorting, a lot more actually long positioning by the banks. They dropped 7,600 shorts and went long 1174. It's almost 9,000 to the upside. So you did see a little bit of pop in the gold price last week, although it wasn't pronounced. And it did, gold and silver also. You saw silver go up to about 32. Gold went up to, mid to high 2300s. People like, we're going on the big run. But then I don't think that's going to happen because it came down this week. So, it's range trading over summer, and we'll explain that. But overall, nothing too interesting. The managed money did drop a lot of longs. And they got taken advantage by the banks who made the money because they dropped their shorts. That's normal. I wouldn't worry too much about that, but that's a commitment of traders. All right, on to my commentary for this week. My commentary is basically this. As I've been doing this for about 5 years, I'm writing 15 years and broadcasting almost 5 years. And as I do that, what I've realized is there's a lot of bunk in the gold and silver market. I just kind of wanted to talk a little bit about that in my own little journey the last couple of years. So the reasons I do this is to try to get to the truth, to help people with their investing, to get to the bottom of things. I haven't been nearly as sensationalist as most people. There's a reason for that. Sometimes I'll do a little bit of clickbaity tile or something like that to keep people interested, but it's always backed up by data, and you guys know that. I tend not to get into every conspiracy theory because a lot of them won't be true, and some of the ones that are true, it's hard to prove. And all that does is it gaslights people and puts them in an emotional state, and they get panicky. And then what happens is those guys come back with a gold provider and they sell you really expensive gold or silver. That's a common trick that's been used in this industry for a long time. I refuse to participate in that, by the way. There's also a lot of gaslighting in the summer, a lot of false information that will come out. And in general, I've tended to stay away from the rest of the social media the last year or so, because I'll be honest with you, when I started, a lot of people I started with are still around, but there have been a lot of new people come on, and there's been a lot of misinformation. There's been a lot of garbage information. There's been a lot of fear mongering. I had a lady come into the store when I had it several months ago and wanted to buy a lot of gold and silver, and she got feared into buying a high premium product when she bought a cheaper one and got more for her money. But she acted out of emotion and out of fear, and it's sad to see that. I've seen a lot of that, and a lot of, I've been going to Twitter saying this. We're going to have a fade in the prices over summer, barring a black swan, a bank failure, war. If you have a big news event, it'll spike gold and silver whenever. But in general, the summer months tend to be weak. You get that price fade. I've been doing that, and one other influencer came on and accused me of working for JP Morgan, almost tongue in cheek, but he was ribbing me because I dared to tell the truth instead of constantly putting you into a fear state and trying to get you to buy from one of my providers. That's the reason I ran the store myself, is because I never did that. And it's the reason that, I will come and tell you the truth. Most of the crap you're going to hear about gold and silver this summer are going to be crap. It's going to be lies, BS, gaslighting, and all that kind of stuff, designed to get you to buy something because it's slow and they need you to buy something, or designed to get views on a channel, or designed to stir up controversy. And you get hooked on the drug of controversy, which releases certain chemicals, gets you excited. And a lot of people get hooked on social media that way. I tend to come into the summer and reduce coverage a little bit because there's not as much really technical news and analysis that I can do when things are slow in gold and silver. I've shifted to doing some content other than gold and silver. To have content, I also think it's important as we get to the end of this economic cycle to talk about culture a little bit more, because it's going to be affected as well. And there's going to be a lot of big topics there. So I'm kind of shifting the channel a bit, but I'm also reducing content over the summer because there's no reason to produce a lot of it. It's slow. And a lot of the crap that you get is the worst crap. And I've tended to want to stay away from that. And I'm distancing myself somewhat from certain aspects of the influencer community in gold and silver because I don't believe in what they're putting out. And certainly some of the new channels that come out, not all, I'm not accusing all, but some of the new channels that come out are full of bunk and garbage and crap, and it's lowering the overall quality. So I'm going to stick with my data-centric approach. I'm going to put out news when I think it's important. I'm going to put out a comment when I think it's important, content when I think it's important. The one thing I will not do is gaslight you. The second thing I will not do is put you in expensive premium products because I get a kickback from it or an affiliation bonus or whatever. I'm not going to try to drive into this heightened emotional state so I can get more subscribers. I don't do those things. And the more that I sort of separate from what I see as the problems in the traditional gold and silver community, the more I'm going to kind of stand on my own a little bit. And that's why you've seen a few fewer guests on my program. I've focused more on my own data and reporting because I believe I can control that. I can't control what other people say. I can't control what other people do, but I can control what I do. And I'm trying to be a new source of integrity and of consistency and quality so that we can reach the truth so we know how things work. And the last thing I want to say is when things are down, I'm going to tell you they're down. I'm not going to constantly blow sunshine at you. I'm going to tell you when things are seasonal or when I don't think it looks too good for prices or when it does look good for prices, because that's what I'm here to do. I'm here to be an analyst. I'm here to do the truth and not just be a cheerleader. Do I cheerlead this industry? Hell yes, I cheerlead this industry. I believe in sound money. But my goal here is to spread sort of that gospel and to help people while allowing people to make their own decisions and not trying to force them down a certain path that makes me more money or makes me more popular. I've never done that. I will never do that. And, you know, being attacked by other influencers, I've gotten used to it. I don't care anymore. I'll tell you this, the gold and silver industry is very dirty from an influencer perspective. People are backstabbing each other all the time. I'm not going to name names and do a tell-all or anything. I don't care. I've just separated myself from a lot of people in that industry because I don't care to play that game. And because I want my channel to further your understanding of markets and further this journey to truth that we're trying to do together, and not to gaslight you, not to put you in a fear state, not to get you to believe something that may or may not be true for clicks, or to just bring sponsors on the program and get rich off of that. I have brought sponsors on the program, but I try to do it judiciously. I think anybody that's seen my sponsorships, particularly over the last 2 years, knows that I've been extremely picky about who I put on the program. And over half of those have been non-paid that I did for free to promote that company, to help the company. And that is the straight truth. And I've shifted to that, even though I get less clicks and views and less money, because I believe that builds integrity, and that's what I'm trying to do. I never tried to mislead anyone or push them in the wrong direction. Unfortunately, I see a lot of that in the industry. I see a lot of backstabbing. I see a lot of nastiness. I see a lot of gaslighting. I see a lot of half-truths promoted. I see a lot of clickbait. And I just refuse to go that direction. And that's just my commentary on that. I'm not trying to piss anybody off or pick a fight. If anybody does a response to this, I promise you I won't see it. I don't watch anybody else anymore because I just got tired of the industry. Every once in a while I'll watch something, not to say that I don't, but I just don't pay attention to that anymore. Just like I've shut out the mainstream media for the most part, other than reading headlines to see what they're saying. I don't engage in seeing a lot of that because I know it's not high value. I shifted to not paying attention to a lot of the other people in the gold, silver, and economic space for the same reason, because a lot of it's crap, in my opinion. Either it's purposely crap, or it's just sloppy, or it's not true, or it's to further the interest of that person or their affiliates rather than getting to solid information that you can use that we can analyze together. So anyway, I just wanted to throw that commentary out there. I'm going to continue to put out stuff this summer. We're going to be a little bit lighter in the summer. I've said that, but I'm still here. I'm still paying attention. You can see I do the data reports just like normal. I can spin them off in 20 minutes every morning. It's not a problem. And we'll do some other stuff outside of that that I think's interesting. This week, we're going to talk about quite a few things in the media that I think are interesting, specifically as it leads up the political cycle. I'm not doing red versus blue team. I'm going to talk in general about that, but things that you probably want to be aware of that goes beyond the economic, but that ties into the economic. So there's a tie there. And I'll continue to do that in short form video content, and we'll continue to put out this weekly market report on Tuesdays. And then as we get closer to the news cycle amping back up in the fall, or if we have an event like a bank failure war, something that causes gold and silver or the economy to get interesting, we'll cover that as well. But I just, wanted to put out general commentary today about who we are and who we aren't. And you'll see people accuse me of this or accuse somebody else of that, and all that garbage goes on. Just know that's posturing in the industry and to ignore it. And know that a lot of what you're going to see, particularly in the down months of gold and silver and in the financial markets during the summer, you're going to see a lot of crap. Take it with a grain of salt. My recommendation is to just take a few days off of social media, stop watching, come back and be objective when you come back and watch the stuff that you feel is helpful to you. If you go watch all the rest of that stuff because it's a big soap opera to you, more power to you. I don't do it anymore, but I get the soap opera aspect of a lot of what goes on social media. And I don't blame people for getting involved in that, but just keep a healthy distance from it. It's my recommendation. Social media can really screw up your view on life if you consume too much of it. In any case, that's enough of my soapbox for today. You guys don't need too much. We'll end it right there at about 30 minutes. Thank you guys for paying attention. I appreciate you guys for supporting the channel. Appreciate doing this. I love doing this every day. By the way, it doesn't pay all my bills, but I do it because I love doing it. And that's fine for me. And that's what I like. And what that allows me to do is be more objective when I'm doing this, because I don't have to worry about all those other things that other channels may have to. And that may be why they're pushing you in a certain direction. In any case, stay tuned to Twitter. I got really salty on Twitter last week. I'm going to continue to be a little salty. I'm poking the bear on purpose because I'm trying to challenge existing thought patterns and what people think is the truth in a way that gets people engaged. And sometime during the summer, you got to poke the bear a little bit because the interest overall is down. And I do that in fun and I do that in jest, not to hurt anybody. And I think it's pretty transparent what I'm doing. But I think now's the time to challenge truths, because the time you don't want to challenge truths is when stuff gets really hairy and you're having to make these really emotional, hard decisions about your finances in the midst of a hurricane. Now is the better time to challenge those truths and talk about that. And we'll continue to do it. All right, I'm getting long-winded. Thanks, guys. Till next time, Rob Kientz, The Freedom Report.